Hey everybody, it's Ray Campbell. It is Friday, July 7th, and we've got some changes in our platform, how we're doing things here. So wanted to give you that information and then of course give you your update here as well. So we are trying to move more towards like a YouTube instead of the bomb that we've had, so we can, add some additional things to our videos and get you additional information, a little bit longer videos that don't take 30 minutes to upload, things like that. A little bit better quality things that you'll actually enjoy watching. So the weekly updates are going to change as well. We're going to be doing more of them actually. So we're going to be trying to get you at least once a week, of course. But instead of kind of just a standard only on certain days, we're also going to be sending out these updates more often as things change. So there's been a lot of things going on recently, and maybe we'll just get back to once a week or twice a week depending on how much market movement we're having. But because of the market, the conditions, we get one report on one day, another report on another day, and it's moving interest rates, it's moving things quite a bit, and it's happening on a daily basis, and sometimes it's happening during the day. So we're going to send out these updates. We're going to change to email from text, so keep an eye out for that. You're going to start seeing the market emails come out in your email, so that way if there's 2 or 3 of them or something, we're not blowing up your text messages and your phones. You can refer back to them in your emails. So keep an eye out for those emails that are going to be coming out to you as well. And the first part of the video is going to be 2-3 minutes with a quick market update, maybe a talking point or two for you to use with your clients. And then anything after that, I'll say something like, finish watching the video for the deep dive or something like that. And then the second part's going to be more of a deep dive into why whatever report that came out, why it affected rates or bonds or the economy, or how that's working and why that actually happened. So if you want to get that detailed information, some of you do, some of you don't, just depends. But the first couple of minutes will be just a quick update and then a deep dive into what's actually going on. So for today, for the 7th, your quick update is interest rates are up. They went up quite a bit and they went up fast. It happened over Wednesday and Thursday. We're actually getting better today, continually to get better today, which we expected to happen. We actually expected it to happen yesterday, but it didn't. And the reason for that is the employment numbers. So ADP is a ADP research. You guys might think of ADP like the a payroll company, but ADP Research Institute is they come out with monthly numbers for jobs, right? And so the jobs number came out was more than double of what was expected. And so essentially what that means is that the economy is still growing faster than people expected it to, which is also going to keep inflation from coming down. And of course, that's bad for bonds. And the Federal Reserve is going to continue to do whatever they're going to do to slow the economy. And they're going to continue to raise rates. And they're still going to say things like they're super concerned about inflation and everything, which is not the full picture, but that's where they're focused. That's what they're looking at. So they're looking at limited numbers over a limited time. They're reactionary. They're not looking into the future. And they do this, and it causes peaks and valleys. And so we typically have market corrections, right? So it's going to go one direction, then it's going to go the other. And they overcorrect in either direction, right? We've had interest rates that were super low for a long time, and then they're making them go up pretty high. So right now you're going to see interest rates in the high 7s, maybe even the low 8s, and that's still probably got some sort of points on it. The 0-point loans are tough to find right now at the higher rates, and so you're just going to have to know that. If you have any buyers who were pre-approved in the last 30 days or so, 60 days, you're going to want to make sure that they talk to their lender right now and confirm that they're still good with their pre-qualification because of how much interest rates moved. We have some people that were pre-qualified using a 6.5, 6.75 interest rate, and some of those right now are 7.75, charging a half a point for, let's say, FHA, and some of them are 8 1/8. It is getting better today, as I said, and we expect it to continue to do that. Looking at bond charts and what's going on, we should have this swing come back, and that always happens. So there's your update as far as that goes. And if you want to stick around for another couple of minutes, I'm going to explain a little bit about the ADP numbers and the jobs numbers and what we're going to be seeing in the future and where they're trying to go. So I hope you guys have a great weekend, and always reach out to us if you need anything. You can call our team number 214-441-7496. So now the deep dive, okay? The ADP numbers came out. We were expecting 228,000 jobs, and it was 497. So it's crazy to see that number. Nobody expected to see that number at all. As I was watching the financial news channels, I was watching Bloomberg when those numbers were coming out. And there's a panel of 5 different people on there, including the chief economist and from Citi, and everyone's face was complete shock. Nobody had a clue that number was coming at 497. In fact, Citi had 170 for the jobs numbers that was coming out today. And when they were asked, they asked them if they said, "Hey, are you going to change your numbers now that this one is a 497 and you guys have 170 for tomorrow's numbers? Are you going to change that?" The expectation was about 230. They were saying it was going to come in low at 170, and then we get 497 the day before, and they're like, nope, we're not going to change it. That 497, something's not right, can't be right. We're going to leave our number the way it is. So they left it, and then the numbers that came out today came in at 209,000 instead of 230. So the problem that we're having is that the numbers aren't matching. They're not adding up, right? So inflation's coming down. We can see the reports month over month over month. The inflation is coming down. We knew that. We've been saying that for months, since October, November. Like, this is when it was going to turn. We told you guys May 10th, keep an eye on that, because that's when the inflation is going to start turning, and it did. The jobs numbers, right? They are coming in lower, but they're still higher than what the Fed wants. The economy is still growing, just not as fast. It's starting to slow down. And so that's where we run into the issue. The Federal Reserve wants to get the economy growth to come to a screeching halt. They want it to stop. They don't want it to gradually slow down. They want it to stop now. And they're doing everything that they possibly can to get that to stop. And because they're doing that, and the things that they're doing with raising interest rates so much so fast, it is causing some issues in financial sectors, and it's causing issues with the banks. And so what's happening here on the mortgage side, now remember, the Federal Reserve raising interest rates reduces inflation, and inflation going down is almost always going to be it's always a good thing for mortgage bonds and interest rates on mortgages, okay? However, what they're doing is causing issues with the banks. The reason it's causing issues with the banks is because it's costing them more money. It's costing them more to get access to money. So they are having some liquidity issues. Also, refer back to SVB going out of business, where they realized that their mortgage holdings weren't valued the way that they were supposed to be. There was a calculation. Instead of putting the 3-month treasury in that calculation, they put a number which was 0, because that's what it was at the time back in 2010, and it was 0, and they never changed that number because they had a number and not the actual market indicator that they were supposed to be tracking. So SVB had issues. They couldn't sell the mortgage-backed securities. They found that it wasn't valued the way that it really was supposed to be, and so that caused some issues there, causing some issues with some other banks. When a bank has to meet their requirements, they have to raise capital, or they have to adjust their balance sheet, and that's what we're seeing as well with banks adjusting balance sheets. And then they're selling off mortgage-backed security holdings, things like that, and treasuries. They're moving their money around, right? People are also worried, or were worried, about the banks, so they pull money out of the banks, which reduces their cash holdings, which then changes how they have to readjust their balance sheet again. So it's this game that they're trying to play and balance out, and that's why we're seeing such extreme reactions to the bond pricing, to mortgage rates, to each individual report. Part of it is because of what's going on there, and there's still some uncertainty on what's going to happen. But also that everybody's pretty nervous about what the Fed's doing, because everybody and basically everyone in the world just about is looking at our Federal Reserve going, please just stop and wait, because you're looking at numbers now that are all lagging indicators and not looking at where we're going, and what you're doing is working. Don't cut the head off. Don't just crash the whole economy and make it come to a screeching halt. Let it come to a gradual slowdown. Those numbers are coming down. What you're doing is working. Just be patient, and they won't. And they've said that. And so for an idea of what we're looking for, the chief U.S. economist just earlier today was saying the Federal Reserve is going to be looking for those jobs numbers to be at or below 100,000. And our jobs numbers that just came out on Thursday, was 497, right? So that's how much more the Federal Reserve is looking to get our economy to come to a screeching halt, right? So that's the deep dive. That's all of the information. Technically, bond prices are coming back right now, and they should. They're going to. There's a whole lot that goes into why they should, and they're going to be coming back. This is a knee-jerk reaction, so it is short-lived. I can tell you right now that since Wednesday, interest rates have gone up above 8% and into the low 8s, and depending on this, we saw one at 8.375. This was just yesterday midday, and then today we're back down into some of them, like conventional 30-year fixed, we're back down into the high 7s. So we've moved over 0.5% just in the last less than 24 hours. Okay, so that's how much things are moving too. So just keep that in mind, that make sure that you're having those conversations with your clients, and also make sure that your clients are having the conversations with their loan officer and finding out the information of what's going on. Don't just let them watch the headline news, because they're going to freak out. Headline news, world's coming to an end, every single time, every day. Don't let them watch the news. Well, at least don't let them just rely on the news, because it's not entirely accurate. It doesn't have the full picture. They never do, right? It's always the headline without all of the information. So hope that helps you guys. I hope you guys enjoy the new way that we're going to be doing this, and how we're getting it out to you, and how often, and the amount of information, and how quickly we're going to try and get it out to you, simply because of how much things are moving. We decided to make this change and had to do some things yesterday to get it done, and I wish I would have been able to get this out to you yesterday, because it would have been real good timing to let you guys know what was happening as it's happening. So that's the idea of making this change and being able to send it out faster, different place where you can go back and view it. And we're also not blowing up your phone 4 or 5 times a week, because sometimes it's happens that much, or maybe even twice a day. Yesterday would have been a perfect example. You would have gotten one in the morning going, oh, this is what's going on, and then by the afternoon going, well, it didn't as bad as we were thinking it was going to. And then today would be same thing. You get one in the morning, this is where we're at, it's looking bad. And then today, and now we're back, we got 5/8 better on the rate. So if you guys need anything, always reach out. Feel free to let me know if you want to see something specific on these, and we'll get it out to you. Hope you guys have a great one, and we'll talk to you soon.